Okay, so you're at the right channel if you want to accelerate your assets. Asset Accelerator. But what do you do if you can't make that work? Because, man, everything is so tight right now. As quick as you earn it, even a high income, as quick as it comes in, it goes right back out. Well, one of the first steps that all of us have to do is just stop the bleeding. And you have a tool, most likely, that can really help with that. We know you've probably seen the headlines, probably maybe even felt it in your own life. Credit card debt is at an all-time high, never been higher, over $1 trillion collectively, all of us. And that just eats away. That's 22% interest or whatever, something like that, right? It just sucks money, not to good things, but to things that we did in the past, bought in the past, most of which we can't even remember what they are, and we're paying a lot of interest to pay for those later. So we have a really big shovel to work with, most of us. If you bought your home 5 years ago or more, your home went up in value. You probably have a lot of equity in the home, and the equity is just kind of sitting there, which is great because that's your net worth. However, let's use that net worth. And let me give you an example right here. Let's say currently you owe just over $300,000 on your home, but it's worth a little over $600,000 now because it's gone up in value so quickly. Everything went up in value quickly during that COVID era when rates were 2.5%, 3.5%. You're the beneficiary if you own that home because it keeps going up in value. Not as quickly now, but you have some equity. You might have a great interest rate as well. I get it. You might have a 3.5% interest rate or something like that. Rates aren't there right now. However, your car note is probably, 8%. Your credit cards are 22%, and you got those student loans that just won't go away. And you want to build assets that produce income. So step number one is let's clear the playing field. Let's create all the cash flow possible and free it up to do something for us instead of for the bank. Look at this example of someone who, their front end ratio, debt ratios, by the way, are just your total debt as a percentage of your total income monthly. Everything on your credit report, your mortgage, your car payment, your credit cards, every minimum payment due as a percentage of your income. Now the front end ratio here, which is the housing ratio, the house is only 23% of this hypothetical person's income. It's hypothetical, but these numbers track a lot with real scenarios that I do for people because I'm in the mortgage business all the time. But look at the back end ratio. It's 51%, right? Back end means the house plus every other minimum payment. And a lot of people look at the minimum payments and they're like, look at it, here's a car loan, $877 a month. It's like, well, I can afford that. Yes, you can, and you're making your payments, but could it be doing more for you? That's the question. So look what happens if we pull some cash out of that equity and pay everything off. Pay off the car loan, 3 credit cards that are just kind of there and they just can't seem to go away, and a student loan that may be there forever if we don't do something with it. Well, the back end ratio, because everything got paid off, is now 31%. It was the house payment itself was 23%, but everything else with the house was 51% of that person's income. We pay everything off and it drops to 31%. You just freed up 20% of your income to do something else with. What is 20%? Well, about $1,600 per month. That you're already earning, it's already coming in. It's just instead of going out to the banks and Sally Mae and whoever, it's now there to be used to start growing assets that produce income. Now, what can you do with $1,600 a month? A lot of people are like, well, I can't do anything with $1,600 a month. The banks certainly can. Visa and MasterCard certainly can. They can be some of the biggest companies in the world because they know that cash flow coming in the form of interest makes them wealthy over time. This way, you're just turning the tables and you're saying, I want to free up that $1,600 a month in this scenario and maybe even take a little more cash out and get another $55,000 cash in hand. You may or may not want to do that, but let's say it's $1,600 a month. Then what do you do with that? Well, you can do a few things with it. Instead of paying it to where it's going now, which is, the BMW payment and the MasterCard and Visa and Sallie Mae. You could put it right back toward the principal on your mortgage if your goal is to be debt free. That's not a bad thing to do. The existing loan would be paid off in 24 years because this scenario, he's owned the home for 6 years. Under the new scenario, if you take that $1,600 that was going to other debt and instead put it toward the house, you'll pay the house off in 12 years and just a bit. So you pretty much cut it in half. Instead of paying the home off in 24 years, you pay it off in 12 with the same cash flow. That's one thing you can do with it. Now, another thing, of course, is to start creating other forms of cash flow, buying dividend, paying stocks. And we'll talk more about that as a specific scenario later, but you can buy REITs, dividend stocks, and just keep putting that in there every month, or save a few months and buy an investment property and create some cash flow and possibly appreciation there as well. So the first step toward going from an earner to an owner is stop the bleeding and use the tools that you have. Position the tools that you have, like equity in your home, to your advantage, right? Because the equity is just sitting there earning nothing. And if you're debt free other than the mortgage, well, then that's great. Leave it, because the idea is to get to a retirement stage, retirement where you can choose to work or not, where the home is paid off. So I'm all for home equity being there, and I'm all for a paid off home. But while the equity is sitting there and everything else is piling up and sucking you dry, let's use that equity as a shovel to do something constructive with, instead of just constantly working to dig out of this other debt, the credit cards and the car payments and all that. Let's use that shovel to start constructing something, to build a foundation for something. And I'm telling you, $1,600 a month is a lot. It's a big shovel to start building a foundation. That's your first step. And then once you get that, well, then you determine, where do you put it? And we'll talk more about that in other videos, but step one first, stop the bleeding and start digging, or put the tools in place at least to start digging a foundation that really creates these assets that will cash flow and support a lifestyle for years and years to come, and do something constructive with your equity.